Ever wondered how investors like Warren Buffett figure out whether a company is actually healthy or just looking good on paper? The answer is right here, in the balance sheet. And trust me, once you know how to read it, you'll feel a lot more confident about money matters. So, what exactly is a balance sheet? Think of it as a snapshot of a company's financial position at a specific moment. It's divided into two main sides: assets, what the company owns, and liabilities, which includes everything the company owes, plus what belongs to shareholders. The golden rule? Assets always equal liabilities plus shareholders' equity. That's the basic equation at the heart of every balance sheet. Here's another thing. In India, the financial year runs from April 1st to March 31st, divided into 4 quarters, Q1 to Q4. So when you look at a balance sheet, you're seeing where things stood at the end of a quarter or the financial year. Now let's focus on the liabilities side. Why? Because it tells you who has a claim on the company's money before any profits reach you, the potential investor. First up, shareholders' funds. This is the money raised by selling shares when the company first started, plus profits that haven't been paid out as dividends. Even though shareholders' funds aren't loans, there's still a claim on the company. Hence, they're shown under liabilities. Let's break it down further. Equity share capital. The number of shares times their face value. For example, 10 crore shares at Rs 10 each equals Rs 100 crore. Share premium. If shares are sold above their face value, the extra is called premium. So, if a share with a face value of Rs 10 is sold for Rs 100, the premium is Rs 90 per share. Reserves and surplus. This is simply accumulated profits the company has kept for growth instead of distributing as dividends. Next, external liabilities. These are actual debts, like loans from banks or money raised through debentures. These must be repaid, often with interest. Liabilities are split into 2 types: non-current or long-term liabilities like loans or debentures that are due after a year, deferred taxes, or long-term provisions for things like product warranties. Current liabilities, which are due within a year, think short-term borrowings, amounts owed to suppliers, or unpaid dividends. Why does the balance sheet always balance? Simple. Every rupee the company uses, whether it's to buy a factory or keep cash in the bank, comes from either shareholders or borrowed money. For example, if a company borrows Rs 100 crore, buys a factory for Rs 80 crore, and leaves Rs 20 crore in the bank, the assets, factory plus cash, equal the liabilities, the loan. To get even deeper, look at key ratios like the debt-to-equity ratio. This helps you see if a company is taking on too much debt. And don't forget to check the notes in the annual report. They explain what each item means. Want to see a real balance sheet? Just search for any company on Money Control, click Financials, and you'll find all the details. If you found this helpful, hit like, share this with a friend, and subscribe for more easy financial explainers. Check out part 2 for the asset side of the balance sheet and start analyzing like a pro. Thanks for watching.